Good morning and welcome. We're in the thick of earnings. You're watching BQ Prime. I am Harsh Saita, and with us, we are going to be discussing earnings with Kalyan Jewelers. We have with us Ramesh Kalyanaraman, who is the Executive Director at Kalyan Jewelers, to talk to us about the numbers, of course, and about festive trends. We're right in the middle of festivities. So it'll be good to get perspective on that count as well. Welcome to the show, sir. Good to have you here and chatting with you. So first, talk to us about how branch expansion is taking place, just for context, right? How many branches are you planning to add in the second half of this year in Q3? We're right in the thick of the festive season, as I did mention. So how will store growth start to take center stage?
Expansion has been on track. We already opened 41 showrooms in this financial year, and we will open 9 more showrooms in India in the non-south markets in Q3 itself. And Q4 we will plan for 12 to 15 more showrooms. So overall, we think that it will be in the range of 65 new showrooms in India, and that is more than or we have surpassed the plan. The initial plan was only to open 52 showrooms.
Right. And what about the Middle East, if I can push you there as well?
Yeah, so Middle East, we opened 1 showroom, and that was the first franchised showroom, which we opened in the last quarter. And Middle East this year, we have already signed 5 more LOIs for franchise. And in the current year, we will open 2 more new showrooms in Middle East.
Right. And so out of these showrooms, India plus Middle East, how many of them will be franchisee and how many of them will be company owned?
So our intention is to make all the stores franchise. But if there is any technical issue for a franchisee to come in at that particular point of time, we might step in and open the store and then convert it to them. So our intention is to make all the store through franchise model, because that is what we are looking for.
Understood. And, how is, talk to us about same-store sales growth. You've guided for higher single digit over the longer term, of course. How is it evolving in FY24 as we close H1? If you can talk to us about that. And what is the kind of traction you are seeing with regard to your new store sales as well? So in terms of trying to understand where will top line growth be like for the next couple of years?
Yeah, so SSG has been strong. Q1, we had an SSG of 15%. Q2, it is approximately 10%. As we speak, festive has also been good. It is a good, healthy SSG, which we are seeing as we speak for the first 43 days. But usually, we always think that 5 to 6% SSG should be what we budget for. Of course, this is higher on ground now, but always budget for a 5 to 6%, because store expansions are also happening in the same metro. We are adding more stores, which might take out some revenue from our existing store. So a target, if you look at 5 to 6% SSG is what we always tell. But on the ground, the SSG is much more. And if you ask for a revenue guidance for the next 1 or 2 years, of course, we will not be able to give a correct guidance, but we add many stores. So this year itself, we are adding 65 new showrooms. Next year, our target is to open 80 new showrooms. And again, the next year after that, we might add more, right? If it is 80 next year, we will add 90, 95 the year after that. So the revenue growth will come from the new stores as well. Again, there will be an SSG which is there on our existing store. So on a conservative, I think, because we are adding store counts, the revenue growth will be strong.
Right. So just to put that into context for viewers, right? Currently, Kalyan Jewelers has around 209 stores. So on that base, if you're looking at roughly 30 to 40 more stores in the current year going forward, you will have another 80 stores on top of that. So probably a 25 to 30% growth in terms of stores, which should aid top line. But of course, not able to disclose the exact percentage or a guidance there. But let me try and quickly move forward. Talk to us about how one should look at margins, because as you move towards the franchisee model and more towards the franchisee model, you've guided that margins will start to come off. Now, your margins have been in the 6.9 to 7.9% range in the last 5 odd financial years, if I've got that right. Where should margins therefore start declining towards? What are the kind of levels that one should look for?
So now, as we speak, almost 20% of the revenue come from franchise. Okay. And it will keep on moving on the upper side. Okay. So in the next 2-3 years, maybe 50-50 might be the number. Franchise will be 50% revenue. Own store will be 50% revenue. Own store comes with an EBITDA margin of around 8%. Franchisee comes with an EBITDA margin of around 5%. So we should look at more of a PAT number, PAT percentage to revenue more than EBITDA margins is what we will always suggest.
Understood. But where should one see steady state margins, or we won't really be able to quantify that at the moment? Is there some kind of a target that one can look for in terms of margins? Maybe not in the current year, maybe in the next year. Where should it start to decline towards, if we can try and understand that?
So the one thing which we can say now is that the revenue, the PBT margin growth will be higher than the revenue growth. Okay, because the franchisee comes with a better PBT margin than our own store. So PBT margins should be better than the revenue growth. Of course, this quarter, Q2, the PAT growth and the revenue growth was same. That is because of certain prepaid expenses like salary, etc. Wherein because we were opening 20 new showrooms for this festive, and we had appointed all the staffs a couple of months before. That is why the PBT margin as well as the revenue margins are same for Q2. But over the time, we should always budget for PAT margin as a percentage will be more than the revenue growth.
Understood. Yeah, that makes a lot of sense. Also, if I can try and understand how the studded mix is evolving, because that is another key contributor to margins. So studded mix in terms of growth, when I look at your numbers, studded mix has grown far better than gold. How should one look at it? Is this a one-off? Is it a lower base? Can we continue to see this kind of growth? What kind of trends are you seeing in that particular space?
Here, no, there are majorly, as you know, there are two drivers for studded revenue growth. Okay, one is the organic growth which comes in the existing store, may south, etc. The studded ratios climbing. Okay, because of customer are now preferring more of bulky, uncut, precious, diamond, etc. Another driver, major driver, is the non-south market expansion. Okay, because all the stores are being added in the non-south region, the studded revenue growth will be surely sharply increasing because that market is for more of studded than premium.
Right. Understood. Point taken. And, you've hinted in this interview more than enough times that there's going to be a shift more towards the franchisee model, right? Which will mean better ROEs. But to try and break this down a little better, what's the kind of capex that that Kalyan Jewellers has to, that it entails Kalyan Jewellers to open a franchisee store? How much of that capex is incurred by you? And therefore, when I look at your ROEs for the trailing 12 months, around 19% ROE, very impressive. Is there scope for further expansion on that count as well, therefore?
Yeah, so franchisee this year, all the franchisees, the fit outs were done by Kalyan and the inventory was invested by the franchisee partner. That was the model for this year. Now, because all the franchisee partners are excited, we are also excited with the existing franchisee stores performance. We are looking for a new model for the next financial year. We are starting to sign for the expansion for the next year, wherein both fit outs as well as inventory will be funded by the franchisee partner themselves, so that our return on capital will be infinite, because we only have to invest the pipeline inventory maybe 20 days of the total revenue. Otherwise, 95% of the investment comes from the franchisee partner. And of course, when you take this route, the ROE and the ROCE will surely climb up, because we are investing very minimal and we are getting that return.
Right. And, so I understand some of those factors that will play out in your favor. And therefore, your ROEs will land up increasing, and that's a positive. Let me also try and shift focus more towards the near term, which is over the next quarter or thereabouts. In Dhanteras, I have a report in front of me, which seems to suggest that 41 tons of gold, 400 tons of silver, and jewelry as well as coins have been sold across the country, which in itself is a marked increase. 30,000 crore worth of gold, silver, other items of jewelry, etc. Now, this clearly seems to suggest that there seems to be a sort of a K-shaped growth curve even here, even in this space. So talk to us, your studded mix in terms of your studded growth has also been higher. I'm seeing some of these reports also come through. What's causing this kind of a K-shaped recovery, and for how long is this sustainable is what I want to really understand.
Two things. One, of course, I can talk only about Kalyan Jewelers per se. So Kalyan Jewelers, if you look at, we have got a lot of new customers over the last 2-3 years. Okay. All these customers have already started coming back. That is why the revenue is keeping on growing. We are adding footprints. That will also help us to increase our revenue. We will increase our market share in the new markets as well. Again, there is an organic shift from the unorganized to organized. So that is also helping the revenue to grow. So I would not be able to give a guidance, but again, formalization has gained more momentum over the last 2 years, and this is real, and I think it's here to stay.
Right. So I'll try and push you a little bit more on that formalization point. So formalization has been dramatic when I'm looking at it over the last 15 years. From the unorganized to the organized, the shift has been quite large. If I recall right, it's from 6% of organized, which was the mix of organized, maybe a decade or so back. It's gone to 30% now. Over the next decade, it's expected to grow only from 30 to 40. Right? So a lot of that will also hinge on new growth coming through, is what my guess is. But that shift from organized to unorganized, largely behind us, would you call it? Or would you still say that that growth will continue to aid you?
Ideally, that's why I told you it's here to stay. Because if you look at our generation or the generation before us, the parents used to decide where you should buy the jewelry, right? Now, the buyer and the user are almost the same. The decision maker is the user. Okay, for the wedding, where the product should be bought is decided by the person who's wearing it rather than his or her parents, right? So this generation want things to be very transparent. They want to come to organized players, and all of us know that we are born somewhere, we study somewhere else, and again we move to somewhere else to work. So they need brands who have a pan-India presence wherein they can come and exchange, they can come and sell their jewelry. So organized chain jewelers are getting all those benefits. And again, digital world, that everyone today, before buying something, they spend good time on the social platforms, and they exactly understand what to buy before they come to the store itself. I'm not talking about the same design, but a pattern is fixed by seeing what the youngsters are wearing, the Bollywood is wearing, the regional players are wearing, etc., wherein customers have an idea as to where to buy. So they want billing to be transparent, buyback to be transparent. They want the freedom to go and exchange the product wherever they travel. So all this is an organic shift from the unorganized to organized is what we feel.
Right. I'll shift back towards the results itself. What we are therefore seeing from you over the last couple of years is there is a better focus on cash flow, and therefore there's some amount of debt repayment which is also happening. How should one look at your debt levels right now as per you? Are you comfortable with the current debt levels, or would you like to continue to repay some of the debt which is on your balance sheet, and would you be aiming to be completely debt free given the fact that you're moving more towards franchisee and therefore less reliance on capex?
Yeah, so you rightly said, if you look at Kalyan Jewellers' journey over the past, say, 3 decades or 2.5 decades, okay, wherein we were using all our cash flow to expand. So there was no scope of a debt repayment. Rather, the debt was increased over the years. But now, because the franchisee partners are also there in our journey, there is going to be a lot of free cash in the book. That cash will be utilized to repay our debt. That is what you saw in H1, wherein we repaid around about 115 crore of debt, and we already have a plan to reduce approximately 15% of our gross debt in this financial year, and that will again continue over the next 2 years. And the cash credit portion of what we see in the balance sheet, we think in the next 2-3 years will be fully repaired.
Understood. 15% of gross debt as well as some amount of cash credit as well. Or rather all of the cash credit as well. Let me quickly take it to my last point with regard to profits within the Middle East. We've seen some contraction happening there. Any specific reason for that?
No, that the only and one reason is because the revenue growth which you saw came from the new franchisee store which I mentioned. Okay, so that comes with a lesser margin. And Q2, the SSG was not there because the base was higher because of ED revenue coming in Q2 last year.
Okay.
This time it came in Q1.
Okay. So the base was higher is what I understand, as well as some front ending of expenses and margin dilution. Understood. Got that. Okay. So thank you so much for taking us through some of those numbers and giving us that perspective. Sir, it's been a pleasure interacting with you, and on behalf of the viewers as well, thank you so much.
Thank you. Thank you very much.